Hello, welcome back to the show. So this is how I plan to create a dividend growth portfolio. So in today's video, we'll be covering a few things. We'll be covering my dividend growth portfolio, how to value dividend stocks, as well as some questions that you guys have left me in the comment section below. So the first portion that I'll be talking about is why dividend growth. So a dividend growth portfolio allows you to do two different things. You can get the growth through capital gains, and you can also get the dividend through the dividend yield itself. So when the market goes down, you will still be able to get your dividend, and then in the future, if you're planning to retire on your portfolio itself, you can just collect the dividends every single month over here. So for a dividend portfolio, how do companies pay out all their dividends? So a company usually pays out the dividend through this metric over here, which is your free cash flow. Your free cash flow is essentially your money in minus your money out, or in a more finance terminology over here, your free cash flow is your operating cash flow minus your capex. So for all your dividend stocks, this is one metric that you have to look out for, which is your free cash flow growth. So more free cash flow growth means the company is able to pay more dividends and give out more money to its shareholders through either buybacks or dividends over here. So when you're picking stocks, you want to pick stocks with high free cash flow growth so that they can sustain their dividend or even grow their dividends over time. So for example, this is S&P Global's free cash flow over the years. So as you can see, S&P Global's free cash flow has been increasing over time, and that is why they're able to increase their dividends over time as well. Same thing for this company over here. This company is even more fantastic. This is MSCI. So MSCI over here, it has incredible fundamentals in terms of its free cash flow growth. Free cash flow growth has been just steadily increasing all these years, and you're seeing that with its dividend itself. So this is when to buy your dividend stock. So you normally want to buy your dividend stocks when they're discounted so that you get a high dividend yield and you also get capital gains on the stock. So this is what you shouldn't do for your dividend company. So a lot of people, I know what they do, they look into just the starting yield itself. So your dividend yield is basically the dividends that is being paid out, dividends per share divided by the stock price itself. So a lot of people, a lot of dividend investors, what they do is they go for the extremely high dividend yield stock, and more often than not, all these stocks, they are dividend traps. So let me show you an example over here. This company is Walgreens. So Walgreens has historically had a dividend that is extremely high. Why? Because dividend is dividend per share divided by stock price. And when the stock price plummets, what happens is your dividend yield will increase over time. So Walgreens over here, they've had a very high dividend for the past few years already. Dividend grew and grew and grew non-stop until in 2024 where they cut their dividends by more than 50%. So this stock over here has historically had around a 9% dividend yield simply because the stock price has just kept falling all these years. And this is a prime example of a dividend trap over here. So this company has stopped its dividends. Now it's currently paying out no dividends. And this is not what you want for your companies. Instead, you should be looking at companies like this. So this is a prime example of a strong dividend company. You want companies that are able to grow its stock price and grow its dividend as well, because this clearly shows that it is a high quality business that is able to give you capital gains as well as dividend growth as well. So this is sort of like a dual investing method that you can use for your stock portfolio. So next mistake that people make is buying companies only for its dividends. So I know a lot of people, what they do is they buy companies simply because they pay out dividends. So for example, they will buy a company like AT&T, for example, because it gives out high dividends. They'll buy Johnson & Johnson. They'll buy all the high dividend yielding real estate stocks. But the problem with buying all these stocks is they are not high quality. So you want to buy high quality businesses, then it will be able to continually give you payouts all these years, because for high quality businesses, they will be able to outlast their dividend, meaning to say they can continually give you dividends every single year. But if you have a company that's extremely high yielding, that is not high quality, one day the dividend could just be cut overnight, like what we saw for Walgreens over here. So here are some of the metrics to look out for when it comes to your dividend stocks. You want to check for the dividend growth rate as well as the dividend payout ratio. So the dividend growth rate is simply just how fast the company is growing its dividend all these years. And normally you want your companies to be able to grow its dividend above the rate of inflation so that they can give you a higher purchasing power than the actual inflation itself, so that the same dollar is worth a lot more than what it was a year ago, discounted for the inflation over here. Next metric to look out for is your dividend payout ratio. So your dividend payout ratio is your dividends paid divided by your net income. So normally you want companies that have a payout ratio of between 50 and 70% for two things. One, it is a company that is safe, meaning to say if let's say the net income drops for 1 year, it will still be able to pay you out your dividends. Number two, you want a low payout ratio between 50 and 70% so that the company can still increase its dividend over time, so that it can give you more dividend growth it has room for expansion. Normally, what you don't want is a company that has around 90% dividend payout ratio. So for example, a company like Ultra has above a 90% payout ratio. And what happens for all these stocks with above a 90% payout ratio is when there's a shock, when there's a down year itself, what happens is your dividends will be cut. And that is normally not what you want for your companies. You want to hold high quality companies that are able to at least hold their dividend or increase their dividends above the rate of inflation so that it gives you more purchasing power over time. So an example of a strong dividend growth stock over here is United Health. This is the largest insurance provider in the entire United States, and it is a company that is going through some sort of a drawdown right now. So let's look at some of United Health's metric over here. So this is United Health's metric. The dividend growth over the past year has been around 11%. Dividend growth of the past 3 years is around 13%. Dividend growth for the past 5 years is around 14%, and dividend growth for the past 10 years is around 18% or so. So this is a company that is able to incrementally increase its dividends over time, and this is normally what you want to see for your dividend stocks. Next portion over here is the payout ratios. So for United Health over here, the payout ratio is around a 35%. This is extremely healthy for the business. This means that the company is able to increase its dividends over time at an incremental rate without worrying so much about the dividends taking up a large chunk of their total net income. So for United Health over here, extremely healthy dividend yielding stock over here. It gives out around a 2% yield right now, which is quite attractive for the quality of the business itself. And that's why I've been adding heavily into United Health over here. Next portion I'll be talking about is how exactly do you value a dividend stock. So there's a way for you to value your dividend stocks over here. It is called your dividend discount model. So for example, let's try it with United Health over here. So this is United Health's fair value over here using the dividend discount model. So they're yielding around $8.4 in dividends every single year. So assuming a discount rate of around 8.5% and assuming a dividend growth rate of around 7%, the fair value for United Health right now is around $560. So the current share price, which is around $400, signals some form of undervaluation for United Health over here. And that's why I think United Health is quite a decent buy now in this current market, with all the stocks being maybe slightly overvalued and so on. Last portion over here, I'll be talking about some questions that you guys have left me in the comment section below. So the first question is from this guy over here. He said, "Great video, man. But isn't S&P Global a bit overvalued right now? Will Warren Buffett buy at this price?" So if you don't know what S&P Global does, S&P Global is a credit rating business. What they do is they rate all the different bonds that people sell, and every single bond, almost all the different bonds in the entire world, in the entire credit market, has to go through either S&P Global or Moody's or both. So for S&P Global over here, it has always historically traded at a quite premium valuation. So if you were to look at the past 10 years of the price to earnings ratio, it has never traded below, I believe, a 25 times earnings. And yes, it is a company that deserves this premium multiple simply because the quality of the business is extremely top notch. So for this business over here, they don't need to reinvest any capital. They're just a middleman or sort of like a rater. What they do is they just stand there, and then every single company that needs to raise debt, they'll have to go through them. And that is just a fantastic portion of the business. And then they have another portion of the business as well, which is competing with your Bloomberg itself. It is the market intelligence business. What they do is they sell all sorts of data, and then all those portions of the data is sort of like a recurring revenue business model over here. So let me address the question over here. Is S&P Global overvalued? So if you're to look at the price to free cash flow metric over here, S&P Global is currently trading at around 25 to 28 times price to free cash flow. I think for the quality of this business over here, it is not extremely overvalued. I have my fair value for S&P Global around $500, which is the current stock price today. So I do think that the stock is around fair value. As for whether or not Warren Buffett will buy at this price, I don't think Warren Buffett will ever buy S&P Global at above 30 times earnings. Warren Buffett is a deep value investor. Like for example, SiriusXM right now, it is a company that has been buying heavily into simply because it is a company that is extremely cheap, price to free cash flow of around 9 times. But on the flip side, you can also argue that Warren Buffett hasn't sold a single share of his Moody's stake over the past 10 years or so. So he's been holding on to this stock, which is called Moody's. Moody's is in a duopoly with S&P Global, and arguably these two businesses over here, they are almost equals. For Warren Buffett over here, he hasn't sold a single share of Moody's, and he probably doesn't think that the share price is so overvalued that it warrants a sell. So whether or not Warren Buffett will buy at this price, I don't think he will, but on the flip side, he hasn't sold a single share. Next question over here. I love your videos. I have a question, but I'm not sure how easy it is to answer. How do you decide what is a good price for stock? As an example, when you say, "I'll buy Alphabet when it drops to $140, what do you take into consideration to land on the 140? How do you know it is a good price?" So Valuation is subjective. Everyone values a stock in a different way. But for me, what I do is I value the stock based on EPS as well as free cash flow and operating cash flow itself. So for Alphabet over here, what I did was I valued it based on the EPS growth. So my EPS growth is around forecasted at around 13%, and assuming a multiple of between 18 and 20 times, Google is around, I believe, 20% undervalued also. That is where I got my value. So my fair value for Google right now is around $180 to $200. That is the approximation of the fair value over there. And the other valuation method that I use is your discounted cash flow analysis. So for Google over here is a lot of capex. So I've tried using the operating cash flow instead of their normal free cash flow, because the free cash flow is suppressed simply because they are investing a lot into capex. So same thing, I got a similar story. Google is trading at a price to free cash flow multiple that is very low historically, and if you're to do a discounted cash flow analysis as well based on the operating cash flow, it is quite undervalued as well, around a $200 fair value. So how did I land on the $140 share price? So for me, Google, they reported earnings this year as well. So pre-earnings, they were at around a $208 a share, and my fair value for Alphabet at the time was around $190, as I said previously. So what I did was post-earnings, $190 is the fair value. So I'll buy when it's 10% undervalued, when it's 15% undervalued, when it's 20% undervalued, and so on. So I averaged down all the way until $138, which was where I last bought Alphabet. This is how I come up with all my different buy entries. So what I prefer to do is I prefer buying in tranches instead of just buying in 1 or 2 entries and so on. It gives me more safety, it gives me more chances to buy at the low, but of course I could miss the upside if, let's say, the stock turns quite quickly. But overall, this is how I allocate my positions. This is how I buy on the way down for Alphabet over here over the past few months as the stock has been continually falling. And yeah, I've just been buying the stock. Last question over here. Are you well versed within biotech and pharma? THTX may go through a merger and acquisition, potential big upside premium. So I'm not too sure what THTX does. I'm not well versed into biotech. Biotech stocks are mostly speculative. So there's a famous investor, it's called Dev Kantesaria. Dev Kantesaria, he is formerly in the biotech industry as well. So he learned the theory behind all those different biotech procedures, biotech stocks and all that. But for Dev Kantesaria, my belief is similar to his one. So what he thinks is that a lot of biotech stocks, they are all speculative in nature. You're just betting on mergers and acquisitions, patents. There is no predictability when it comes to all this stock. So he doesn't take pleasure in a stock going up 100% in a day. Similar for me, I don't think I want my stocks to be going up 100% a day, because the next day, that same stock could fall 100%. And that is usually not what I want for all my different businesses. I want predictable stocks. I don't want speculation. Same for Dev Kantesaria. He also doesn't want speculative stocks. He also doesn't want companies that are extremely unpredictable, like your biotech stocks. And so for me, I would stay out of biotech. I would stay out of pharma. The only pharmaceutical stock that I've been looking at over the past few months or so is Novo Nordisk, simply because of the valuation itself, as well as the growth of the healthcare obesity market over here. So the obesity market is projected to grow at around 15% all the way until 2030. And for Novo Nordisk over here, it was a company that grew 21% last year, currently trading at around a 17 times earnings. So I do think that Novo Nordisk is presenting a decent buying opportunity right now if you're looking at pharmaceutical stocks. But generally, I think pharmaceutical stocks, they face high regulation, they face a lot of competition, and more often than not, it ends up being a price war for all the different products, and that's why I haven't looked into it yet. I'll look into THTX. Maybe it's a stock that could 50x in the next few days. But more likely than not, I won't be buying into the shares because I don't know anything about the pharmaceutical industry. I don't have any edge above others. I hope you guys have found this one useful and invest safe.